Bloomberg Audio Studios. Podcasts, radio, news.
We're joined on Bloomberg TV and radio by the chairman, Jared Bernstein, chair of the White House Council of Economic Advisors. It's great to see you. Welcome back.
Great to be back here with the two of you.
This is framed as an exit interview. I don't know how that makes you feel, but we'd love to talk about a couple of different things. And if that's the case, as you pack up your office, I want to start with the fight of your life, which I believe is the fight you waged against inflation for the last 4
Oh, I thought you were talking about my confirmation hearing.
I thought maybe you'd pick something else, but I think we can agree that's what you've spent the most of your time on, and it's what we've spent the most time probably asking you about. When you look at a chart over the last 4 years of CPI data, it looks like a mountain.
Yeah.
You crested the top of that mountain a couple of years ago, and as we look at that chart now, we'll share it with our viewers on Bloomberg TV and on YouTube. I wonder, one, how that makes you feel, if it brings back some PTSD.
There's traumas in some of those.
Yeah, I believe that.
There, yeah.
But also, when you look at that, do you think, look how much progress we made, or how much left we had to do?
Both. Certainly progress we've made. I mean, coming down the other side of that mountain was critically important. But you know, Kailey and Joe, for us, the fight was never just about getting inflation back down. That was absolutely key, and we're proud of the work we did to help that. Yeah. Specifically, by the way, the Supply Side Disruption Task Force. That's not something you hear a lot about that, but we were probably talking about it back in 21. The president realized quickly that it was snarled supply chains that helped cause that inflationary spike, in part, along with strong demand. And unsnarling those chains was going to be really important. But the thing that the president recognized was that we also had to worry about costs, the price level, not just inflation. And that's why, starting shortly after that peak, we started talking about what we were doing to lower costs. Because it's one thing to get grocery inflation from 13% down to around 1.5%. That was a huge and important accomplishment. But that just means your grocery prices are growing more slowly. It doesn't mean they're coming down. And a lot of people really wanted more deflation, not just disinflation. So our cost-cutting agenda was also a critical piece of the fight.
Mm-hmm. Well, and your point is well taken on how supply-side factors did ultimately contribute to the higher price pressures. But you mentioned demand there as well. And certainly you're familiar with the Republican argument that it was too much fiscal stimulus that fueled demand and fueled inflation as a result. When you look back on it now, do you think the ultimate trade-off was worth it? Keep the economy and the labor market in better shape through some of those stimulated efforts in exchange for what could have been that additional marginal pressure upward on prices?
I do, with the following asterisk or caveat, which is that if you look at the trajectory of inflation or the cumulative amount in which the price level grew across every G7 economy, it's pretty much the same in every one of them. And they all had different fiscal and monetary policies. So I think it's a mistake to assign too much of that increase to fiscal policy. And I think the Republican argument is fundamentally undermined by that international comparison. That said, the other part of the way you teed up the question is really important, which is what did we get? So we are now handing off one of the strongest economies on record, and by some really important measures, whether it's the number of jobs, a 4% average unemployment over this administration. That's an historical achievement. And of course, the stock market doing great in the past couple of years. All of those indicators do take you back to punching back as hard as we could against the pandemic-induced recession. So I want to be very careful about not suffering from any of the amnesia about what was going on in January 21 when we got there and how our policies helped get this economy back to full employment where it's been ever since.
You've been very disciplined about staying independent from the Fed and not answering our questions about the Fed for the last 4 years. I salute you for your consistency. Every now and then we got a little bit of a crack out of it when it comes to, I just wonder, I don't know if you feel more or less shackled now than you did in the throes of the administration, but did you feel in sync with the Fed from transitory to the first cuts?
Well, first of all, people ask me right now, what are you going to do after this job?
Yeah.
And one of the things I say is I'm going to talk about the Fed. So
hopefully here first.
Certainly going to remain pretty quiet about the Fed as long as I'm still chair of the CEA. I mean, look, I think one place I take your question is just how much we valued Fed independence. And that wasn't just some, weird kind of idea we had. We're just acutely aware that economies have been brought to their knees by compromising the independence of the central bank. And that's largely because of unforced errors on inflation. Now, in some cases, I think there are many critics who worry about the incoming Trump administration's policies in the context of being inflationary, whether it's deportation or tariffs or lots of tax cuts. And, I'm not going to go there myself. I want to give these guys a chance. Let's see what they do. They don't want higher inflation or interest rates. I think we can be pretty clear on that. But once you start messing around with Fed independence, I think you're making, a pretty fatal mistake in terms of controlling inflation.
Well, you just said they don't want higher inflation. But do you think ultimately, when you look at the layout of the policies, at least that they've outlined, if not into the granular details that we may have yet to get once Trump takes office, that is what is going to result, is that it's going to lead to a new spike upward in prices?
Kailey, again, I want to give this incoming team the benefit of the doubt. I know some of these folks, they're good economists. They don't want to generate higher inflation or higher interest rates. But if you do look at the impact of, say, sweeping tariffs or deportations or fiscal stimulus through unnecessary high-end tax cuts, really also hurting the economy's fiscal outlook, all of those, of course, are inflationary. And then if you add in compromising Fed independence, you've got a real problem on your hands. I don't think they want to go there. I will say the following. If there are those who think that, hey, we did tariffs in our first administration and it didn't hurt us on the inflationary side, 2025 is a lot different than 2017, right? There you're looking at an economy where you were missing inflation from the downside for something like 5 or 10 years. There you're looking at an economy where interest rate yields were very low. Now you're talking about an economy where inflation is making its bumpy way path back to target and yields are, if anything, going the other way. This is a very different climate to be considering those kinds of ideas. And I would say in that regard they have fewer degrees of freedom. And again, I think they know that.
Independence, though, as a principle is something that some would argue is being challenged right now by this incoming administration. The man who was just experiencing his confirmation hearing earlier today, Scott Bessent, the potential future Treasury Secretary, floated the idea of a shadow Fed chair. Is that our next reality?
I don't think so. I mean, again, I think there are things one says in sort of the think tank world.
Yeah.
The Bible says, when I was a child, I spake as a child, but then when I chaired the CEA, I had to get a lot more serious. And so I think
you're giving this team the benefit of the doubt.
I think that, obviously that's what, I've said that numerous times and I want to pursue that. But I also think that the idea of hitting this economy with higher interest rates, higher inflation, I think any economist worth their salt know that that's not where we want to go.
We heard the president in his farewell address last night also say that he wishes the incoming administration success because he wants the country to succeed. And just a few minutes later, he went on to warn of what he sees as a burgeoning American oligarchy, talking about the concentration of wealth and power. And I wonder from an economic standpoint how you do view that, this widening inequality we are seeing take place in America.
Well, that's exactly how I view it. And I'm glad you went there, because when I heard the president talking about that, it brought me back to one of the first meetings I had with Joe Biden, our first extended meeting, which was in December of 2008 when he was the vice president-elect. It was at his house in Delaware, and he was looking for a chief economist, and I rumbled in there, and he pulled a graph out of his pocket, one that I had made, a folded piece of paper. He unfolded it, and it showed productivity going up, up, up. This is a graph that I'd made with Larry Michel, the great labor economist, and median wages, median income's flat. And he pointed the gap between the two of those, and that's inequality. He said, this is what I want our work to address. I want to close that gap. And Bidenomics to this day, I describe, is that if you're helping to bake the pie, you ought to get a fair slice. So to me, what he said about this threat of excessive wealth concentration is part and parcel of his concern about the regular working middle-class Americans who build this economy every day getting their fair share of the growth.
Yet it must have frustrated him to not see them connect with his vision throughout polling. It was obviously a campaign that he dropped out of with the economy as the number one issue here. So what was the most frequent question he would ask you, Jared? What was he actually waking up worried about when that was the dynamic you were dealing with?
Well, interestingly, you say frustrating, and it's an interesting point that makes me think back to conversations we had. He was constantly bolstering his staff, including me, saying, look, I know it's frustrating, to be seeing this out there, but I've been through this before.
Wow.
I've been to this rodeo, and we just have to keep pressing. We have to keep getting the economic job done on behalf of the American middle class. And so he was obviously very gratified to see. And this is something he and I worked on from the very beginning, going all the way back to our, throughout our relationship, was the idea that if you run a full employment economy, the benefits of the growth that you're helping to generate will disproportionately reach the bottom half. Well, look what's happened to wages. I know you've talked about this and documented this at Bloomberg. Low wages did the best. Low wage growth was the strongest. That comes right out of this running this Biden-esque full employment economy. The black unemployment rate over Joe Biden's 4 years was the lowest on record of any 4-year term. All right? That's huge support for, I think, the president's theory of the case. Now, you can ask about the disconnect between that and politics. I think that takes us back to the price level and that discussion. But the president was well aware of this architecture of how the economy works and recognize the progress we made on it.
And we'll leave it on that note. Jared Bernstein, the outgoing chair of the Council of Economic Advisors, thank you so much for joining us.
Thank you.
On Bloomberg TV and radio.